Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks in the red Tuesday, following from the latest record-setting run. AI and tech optimism still persists. We're going to be digging into that a whole lot more. But right now, there is just an hour to go until the closing bell. Stocks are lower. Let's take a look at the popular averages. The Dow is down about 136 points. Your broad gauge, the S&P 500, down about 0.4%. Tech-heavy NASDAQ down about 0.6%. Let's welcome in now our data and markets editor. That would be Jared Blickery. Jared, what are we seeing in today's trading action so far, my friend?
It is a flip from yesterday. We were watching records across the board, indices, gold, Bitcoin, you name it. Not today. A little bit of a pullback, 140 points in the Dow, or about 0.3%. Here's the intraday price action. We started out in the green. We had a couple records. I don't think the Dow, but S&P and NASDAQ early, but not right now. It doesn't look like we're poised to close there. But as I said, just kind of nominal losses here. The NASDAQ down 0.6%, the S&P 500, similar chart, down about 0.4%. And as I like to show, let's show the Russell 2000. That's kind of leading the way down, an outside move of over 1% to the downside. And what is going up today? I want to show you what's going on in volatility land. This is something I'm going to be talking about to Josh in about 90 minutes, but just want to show you the VIX heading up to 17.4. Haven't seen that level in a few months, at least on a closing basis. And so we're going to dig into what rising volatility, and that's something that happens this time of year in October, what that means for the markets. Also seeing investors buy bonds, and since price in bonds, it moves opposite the yields are going down today. And so we see the 10-year down 4 basis points to 4.12%. 30-year also, well, that's down 3 basis points now to 4.72%. Meanwhile, the US dollar index going the opposite direction. And also, I'm going to throw in the Japanese yen. I don't usually show this, but it has been screaming higher after a surprise election over the weekend. I'm going to talk about that in 90 minutes with Josh as well. So let's check out the sector action. Not a lot in the green, and what is in the green is defensive. So number one on that list is XLP. That is staples, up about 2/3%. Utilities up about 1/3%, and then financials and healthcare also in the green. To the downside, we got consumer discretionary that is leading to the downside, then tech, then industrials. So tech and the cyclical trade not doing too well today after a screaming performance by AMD and the chip stocks yesterday. While AMD is up, it's up about 3.5%, so tacking on some gains, but for the most part, a lot more red than green here. That's the NASDAQ 100, and I will show you quickly the Dow, where we have kind of a mixed board, but what's green tends to be more defensive. Procter & Gamble, United Health, Coca-Cola, each of those up more than 1%. Josh.
Thank you, Jared. Well, NASDAQ is coming off its 7th win in a row. News on Monday of a multi-billion-dollar deal between AMD and OpenAI, only adding fuel to that AI-based fire. But the flame may be burning too hot, as Oracle reportedly did lose nearly $100 million in NVIDIA Blackwell chip rentals. Here to discuss the AI landscape is More Insights strategy founder and chief analyst. That would be Patrick Moorhead, along with the Futurum Group CEO Daniel Newman. Fellas, welcome both. It is great to have you here. Correct me if I'm wrong, but is this the first joint Patrick Moorhead, Daniel Newman interview? Is that what we see here?
It sure is on
Wow,
broadcast.
history being made.
Yes.
History being made.
280 episodes of the 6-5
Exactly.
podcast partner.
Yeah.
Not a single
All right,
time that we've been on together.
Pressure is on. Here's the topic. I can't think of two better guys to talk about this with. I want to get your take on the AI spending boom, because we do hear skeptics coming out.
Sure.
And these are not guys you can just dismiss. These are some very well-known, well-respected investors. And you're hearing them talk about maybe an AI bubble. They'll say, I'm hearing echoes of 1999. It's kind of some spooky stuff. I'll start with you, Daniel Newman. You hear this talk. What do you make of it?
Yeah, I think it's a lot of hot air in that balloon. I do think that there are little bubbles within the overall AI trade. Companies that have zero revenue, that are getting $10 and $20 billion valuations. You see it with some of the quantum names. You see it with some of the energy names that are just running really fast. But you look at the operating leverage and the strength of the largest, the Mag 7s, the Broadcoms, TSMCs, ASML. These are sturdy companies with incredible balance sheets that are making very intelligent bets on what the next 5 to 10 years are going to look like. And by the way, one thing on 1999, when in 99, the earnings were not even close to keeping up in terms of the companies and the prices of these stocks. it's not the same case. If you actually look at the line of how the earnings are matching with the revenue growth and the price appreciation, it is right in line. So I think a lot of people want it to be a bubble. I call it this is just the most hated rally of all time. But I actually think there is a really bright future, and that AI is really only in its beginnings, Josh.
So Patrick, I'm going to ask you the same question, but maybe I'll just frame it a little differently. How confident are you that on the other side of what's literally going to be trillions spent here, that investors are going to see on the other side of that, they're going to see, okay, we're going to see material, meaningful revenue generation?
Yeah, so I was working at a .com during the .com boom and the .com crash. But I do want to buttress it on one end and just say I'm confident for the next, let's say, 2 years, as long as the hyperscalers can be funding their CapEx with cash before they have to be diving into debt or doing some equity financing. I feel really good about that. But to answer the question, I feel a lot more confident than I did during .com. There were so many different bad business models that were out there. Literally, if you have access to a browser, you can get the benefit of AI. We have connectors now, we have APIs, we have ecosystems that quite frankly didn't exist. Am I going to Babe Ruth this? Absolutely not. We should be asking these questions, and what we should be looking at are milestones of that downstream value.
What are the kinds of milestones you're watching, Patrick?
Well, the first thing you're going to see is you're going to see a cool down in spending on CapEx with the hyperscalers, or you're going to see some I would say hard questions that investors are asking them. I think we have to start to see agentic frameworks that can be developed horizontally through the Microsofts, through the Googles, the AWSs, in conjunction with, I'll call it enterprise SaaS, where they are actually delivering higher levels of revenue and utility. On the consumer side, what I really want to see and what we should be concerned with is if we're not seeing increased revenue or new services based upon this. I feel pretty good, I feel better longer term than I do midterm, because I think if we get to AGI paying that $200 per month per a lot of people on the planet, will deliver incredible value.
What do you make of that, Dan?
These companies are making a big bet on the future. The problem is people are having a really hard time bifurcating now and 5 and 10 years into the future. They are saying things like, well, we're not getting AI revenue today. Companies like Google, Microsoft, Amazon, they're betting on a 5 and 10 year future. The reason they're making these deals with Nebius or with an Iron to get all the capacity, the reason that Sam Altman is working with AMD and working with NVIDIA. Won't be surprised to hear an Intel announcement in the future. And the reason this is because he knows the only way he can continue to get the growth is to make sure he has all the compute capacity required. So this energy requirement has to be built out. The compute demand, literally every GPU and custom AI chip that can be built, Josh, will be sold. So if you look at what Pat said about the multi-year, it's not just the 2 years. The 2 years, we're going to continue to see a massive chip spend. But 5 and 10 years in the future, Microsoft needs to buoy its business model. And if it doesn't have the capacity to deliver these AI experiences in 5 years, this is how the big fall. And so they are making the investment now, they're putting their strong balance sheets and they're using their operating leverage to make sure that 5 and 10 years into the future, they can't be disrupted.
Patrick, you mentioned the hyperscalers. You think Amazon, Microsoft, Google. Increasingly, you would have thought of Larry Ellison and Safra Catz over at Oracle. I do want your take on this report today because it got a lot of attention.
Yeah.
Oracle was lower. The information, they talk about Oracle, they say that its profit margin in its cloud computing business lower than maybe what a lot of the street were thinking, that Oracle generated, they say, around $900 million in revenue from the rental of servers powered by NVIDIA's chips, but only around $125 million in gross profit. What did you make of that?
So Josh, you and I talked about this on this show, and what I said was that there's no way that that average for cloud is going to be the same as let's say their software, their SaaS business today. So I'm not surprised at all, particularly because they're breaking into this market. They had hyperscaler, they had infrastructure as a service, but they had never really gone big and laid down the investment. And what they're doing is, in a couple of years, they're making up for not investing nearly as much for the next decade.
I want to ask you, Dan, too, about OpenAI and AMD. That stock roared on that. When you saw that announcement, did you think, yeah, that's justified? That makes sense to me.
Well, first of all, just really quickly on the Oracle deal.
Yeah.
I actually am very skeptical of the reporting. I'm skeptical of
Why? Why do
the
you say
math, the accounting, the way they tried to, because that level of granularity is not in the reporting. So that had to be extracted and extrapolated from that. And the idea that that kind of CapEx spend is going to return profit this quickly, it seems to be something you build FUD, or you're kind of building a negative bearish narrative around. But I think Oracle knows, as I just said, they need to be betting 5 and 10 years. They're investing for the long tail. They're not only playing the game for the near term. That report makes it sound like that both NVIDIA is inefficient and Oracle doesn't know how to run its cloud business. The AMD deal was kind of brilliant. Lisa Su doesn't have the balance sheet to put $100 billion into OpenAI. So instead, the way they structured it, it gave very much a win-win. She gave a ton of incentive to Sam Altman to use more AMD. And all the people in the NVIDIA circles that are so surprised by this, they've been working together. This is not a new thing. Inference was the pivot. AMD has the opportunity to be a huge inference partner. And if Sam Altman is successful, deploys a ton of AMD, Sam Altman's going to have $100 billion or so in AMD stock. So I think it was a great way to play, great way to make sure AMD is in the game and it's going to contribute. But for all those out there that think this is a really bearish thing for NVIDIA, NVIDIA is still going to get the lion's share of the volume.
On that, last question to you, Patrick. When you saw that, is that partnership, is Sam Altman in any way suggesting that there is no performance gap between AMD and NVIDIA?
I think what he's doing is suggesting that AMD is in the game, okay? And we're within percentages, right? Not miles. And it would make sense to me because architecturally, both of these solutions in this time frame are what are called a rack scale, meaning it's the entire rack, everything is optimized. And AMD, quite frankly, didn't have the technology, and NVIDIA does. And now I think they're competing on a more level playing field, and it's up to NVIDIA, which has done quite well, as every generation, it goes a giant step ahead, right? They rethink something, and they have to be cooking something for 27, 28. They're not going to lose tremendous amount of market share. But to Daniel's point, it doesn't mean NVIDIA loses here. But what it does is it means that AMD is a serious hyperscaler AI data center player. There were doubts, right? Because AMD didn't give a forecast like NVIDIA did, right? And they would never commit to a number, right? Now, I've heard Lisa talk through this, Lisa Su, and the number never would have been good enough for anybody, because even if you put it up against NVIDIA's, it would be a very small percentage. But now, right, I'm not going to say they're on equal footing, right? They're still 10%, 90% players right now, but I could see on a percentage basis AMD picking up some percentage market share. But to Daniel's point, doesn't mean that NVIDIA loses. They can actually both grow. I think you heard Brockman say this yesterday.
Very last question I want to squeeze in. We've been talking here about all the potential AI winners. As you look across the landscape, as both of you this, now and ahead, what are the kinds of companies, Dan, that you think, hey, they're at a structural disadvantage? These could be AI losers.
Yeah, I think the category that everybody's come to agree on here, Josh, is it's the enterprise SaaS and applications companies. They're at the highest risk. And here's the reason why. In the future, these agentic workflows that Pat mentioned, they're going to be able to, just like we do with ChatGPT, you're going to ask it a question, and it's going to be able to look across your entire data estate. It's going to then be able to abstract you an interface, and it's going to be personalized to you. Right now, when you use a CRM or any sort of ERP platform or an HR platform, predetermined or highly customizable, lots of consulting, lots of spend, lots of seats, and the way that whole business model works, I've been saying for a while, the software industrial complex is going to be reborn. So the winners of the SaaS era are going to have to make a really hard pivot. So the Adobe's, Salesforce's, ServiceNow's all under pressure. I think ServiceNow's done a pretty good job telling its story. I think obviously Salesforce is trying with Agentforce, but in the end, Google is saying build your agents with us and build it all with us. Yeah. And that is definitely creating new calculus for these companies that have had a multi-decade run.
Quickly, Patrick, you agree with that?
I do, and I want to characterize that it's a foot race between what I call the horizontal agents from the hyperscalers versus the enterprise SaaS agents. They have agents too that are very vertical. And the bet that the enterprise SaaS companies have is they can do it quickly enough, less friction at a reasonable cost and a reasonable premium. Some of these enterprise SaaS companies are giving their AI away for free versus this other structure that says, I'm going to build these horizontal, I'm going to have these horizontal agents, and I'm going to save money because I don't have to pay the premium for enterprise SaaS. Enterprise SaaS is not going away. The question is its growth. And are enterprises going to give the extra money to the enterprise SaaS vendors for that AI magic, or are they going to invest in these horizontal agents?
I think some of it will go away.
Fellas, great to have you both here on set.
Thank you, Josh. Appreciate that.
It. That was terrific. Thank you. Tesla looking to reignite car sales with a new initiative. Our senior autos reporter, Pras Subramanian, joins us now with more. Pras, what do we know so far about Tesla's latest announcement here?
Yeah, Josh, it's finally here, right? These new cheaper EVs are here. So on Tesla's website, they announced the Model Y Standard is a stripped down Model Y costing a little under $40,000. So what you got here is a less lighting in the front. You got rid of that full wraparound light bar in the front and rear. You have cloth seats inside. You omitted the second screen in the back. Some decontenting, as they call it, to make the car a little bit cheaper. So that'll go on sale in November, December. Also, they also announced kind of in a surprise the Model 3 Standard as well. And that's going to be a shade under $37,000. So this is all, like you said, sort of here to address the concerns of Tesla's sales, which were up quite a lot in Q3 because of the expiration of that federal tax credit. What happens in the fourth quarter is anyone's guess, but these two cheaper models are supposed to help boost sales.
All right, Pras, thank you. Appreciate it. Coming up, investors looking for any policy signals as a slate of Federal Reserve speakers may make remarks today. We're going to tell you everything you need to know. Plus, Tesla looks to reignite car sales with a new push, and Netflix stock is getting an upgrade. We're going to tell you why some investors are bullish on the streamer's performance. Those stories and more when we return. A lot of Fed commentary coming out on Tuesday. Here to help us break it all down is Yahoo Finance Fed correspondent Jennifer Schonberger. Jen.
Hey there, Josh. There sure is a lot of Fed speak today, and officials are still split about how much further to cut interest rates, with some more concerned about inflation and others more concerned about the job market, as the government shutdown deprives policymakers of key economic data they need to make monetary policy decisions. And earlier today, we heard from Fed Governor Stephen Miron, who reiterated he wants to get to neutral. That's a level on interest rates that neither spurs nor slows economic growth faster than his colleagues.
One thing I've said in the past is that I think that the neutral rate has recently come down relative to where it was a year ago. That makes monetary policy more restrictive than it was, say, a couple of quarters ago. And that additional restrictiveness of monetary policy poses some risks going forward, because if policy is tightened, then with some lags to policy, you would expect the economy to weaken. So in the near term, I'm not very pessimistic at all about the economy but I do see some risks lurking there if we don't adjust policy.
Miron has penciled in 5 more rate cuts this year. That compares with the median of just 2 more cuts from his colleagues. And Miron is looking to cut rates much faster because he's more optimistic inflation is going to fall, as he expects housing inflation to fall. He also believes that with lower immigration and what he expects will be a lower federal deficit thanks to tariffs, lower rates are in order. On the other hand, Kansas City Fed President Jeff Schmidt said last night he's more concerned about higher inflation and that the current level on interest rates is, quote, the right place to be. In reference to cutting rates further in a speech last night in Kansas City, Schmidt said, quote, the current environment is one where aggressively boosting demand could raise the risk of an outsized increase in prices as firms gain pricing power and increase the pass-through of tariffs to consumers. Now, Schmidt noted the fact that prices of durable goods, so things like washing machines, refrigerators, televisions, the fact that they're all increasing is notable given that durable goods prices have actually fallen steadily over the past 30 years. At the same time, he also pointed to increases in prices for services, so things like haircuts or getting our lawns cut, and those have been increasing around 3.5% over the past couple of months, well above the Fed's 2% target. And of course, Fed officials flying blind right now during this government shutdown without official federal government data. And Stephen Myron had said earlier today that private sector data are not a substitute for official government data, and that, quote, the Fed officials are deprived of the data they need most to make monetary policy decisions. Josh?
All right, thank you, Jen. All right, now time for some of today's trending tickers. Aptus Capital Advisors David Wagner joining me here for a look at Trilogy Metals. We'll talk a little Netflix, some IBM. David, it's good to see you. So let's start with Trilogy Metals. Those shares soaring. Look at that move as the Trump administration takes a 10% stake in the company. Remember, this is, of course, a minerals explorer. Bloomberg has a write-up here noting this is part of a nearly $36 million investment, David, secure critical energy mining projects in Alaska. And we have seen this sort of broader strategy, right? So we had last week, U.S. agreed to acquire direct investment in Lithium Americas, right? Then over the summer, David, you remember, U.S. agreed to a $400 million equity investment in MP Materials, fund a plant for rare earths. What do you make of this?
Yeah, Josh, one, thanks for having me. But it's all becoming, for us, the United States, becoming more dependent on ourselves, not the rest of the world. And what we've learned about this Ambler Road that's needed to be built, it's a 211-mile road that needs to be built to be able to get to basically this copper mine. I mean, me and you know both that copper is basically the number one factor that we need to look at as investors that could presage, manufacturing overall from an industrial standpoint, from a construction standpoint, but most importantly, a technological standpoint. I mean, copper is so important to that industry, specifically on semiconductors. And in this race for AI, we know Donald Trump, he kind of wants to become his own Francisco de Arcanillo, one of the main protagonists in Ayn Rand's Atlas Shrugged. Obviously, he was in Chile. We're talking about Alaska now, but Trump, he absolutely knows that there's so many amazing basic resources up in Alaska, and we need to finally tap them. And this is kind of one of the last legs, this last road that needs to be put in place so we can go after this copper.
All right, turning now to a different name here, Netflix. That stock getting a lift over at Seaport as the firm upgrades shares from neutral to buy. They are believers, David. They upgrade to buy. We note they say continued year-over-year market share gains versus linear, continued professional curated content they talk about, driving engagement leadership. Stock momentum has recently stalled, but they say could reflect some just digesting gains. Ahead, they say, of the advertising infrastructure built related monetization momentum. Their target is $13.85. Seaport not alone, we should mention. I mean, most on the street who cover this name tell clients you should be buying it.
It's the bellwether in the space. It's either you own Netflix or anyone else, and you're going to want to own the bellwether here. I mean, David Joyce, he's the analyst over there at Seaport. Known him a long time. Very smart guy. He's had a lot of great calls with this name, but you hit the nail on the head there. It's all about operating leverage in regard to its overall advertising spending. And right now, at least per Seaport, they're expecting an annualized growth rate on the advertising side of 48% over the next 5 years into 2030. I mean, I get it. The knock on the stock is always going to be valuation. But let me say that again. It's always going to be valuation. So I'm a big believer of price is what you pay, value is what you get here. And you're kind of going to get like that Amazon effect there, because Amazon obviously got a big boost, which helped their operating leverage on the advertising side of things. And you saw them grow into their multiple. I mean, we're pricing Netflix right now at 40 times forward earnings. I mean, if you look at Seaport's projections, out in 2030, and that's what they think that investors should be looking at too, because that's the advertising story. Like, you get an earnings per share of 30 times. And to be quite honest, that name alongside the Magnificent Seven, if you can get that core characteristic of operating leverage, I think 30 times is a pretty good deal.
Do you look at, someone will argue the streaming wars is over, Netflix is king, everybody's just battling for second place. Now, of course, there's a lot of potential money in second place.
Yes.
Is that how you see it?
I would say yes, and I think this has been something like 10 years in the making for Netflix, because they have such a very much different model than all of their other peers. All of their other peers, it's all on the CapEx number. How much money are we spending on new content? I mean, that was a story for Netflix for a long period of time. That was a story for Disney still to this day. But they have so many other partnerships out there where they can diversify their revenue streams and, more importantly, diversify their costs, which benefits their operating leverage from a bottom line approach where they kind of are the only name in town right now. And then the kicker is obviously the international growth story.
All right, last one I want your take on IBM. Let's talk about Big Blue, partnering up with Anthropic on enterprise software development. So this one, David, listen, yes, OpenAI, of course, has been making deals, but they aren't the only game in town. Now, IBM's saying it will integrate Anthropic's AI tech into its software. It's going to make its cloud family of LLMs, large language models, accessible for clients. By the way, Barron's reminding us IBM open to OpenAI as well. Those two had also collaborated earlier, but it does seem like investors, you throw an AI strategic partnership out of there and the stock moves.
That was going to be my first point here.
Yeah.
It's all about partnerships. You're either partnering and growing or
getting left behind.
You're not, yeah, absolutely. You're partnering and becoming obsolete in some type of way. I mean, IBM's been a great company for quite some time. I'm not surprised by the action today because it's the stock's up maybe 1 or 2%. This is not a game-changing deal whatsoever. It's kind of more of a nuts and bolts type of integration in my mind because obviously with Claude and Anthropic, you're really trying to tap into the intellectual property of IBM because especially on their consulting side, they kind of have the best lens into how Gen AI is being adopted across a cohort or slew of different industries. And so to be able to get your leg in the door with IBM to get that data and information, especially on the security side of things and on the compliance side of things, I think it was a smart partnership.
All right, thank you, David. Appreciate it.
Cheers.
Coming up, we're examining 2 stocks that could be a good buy or leave you saying goodbye. That and a whole lot more coming right up. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves for your portfolio. I'm here now with David Wagner, Aptus Capital Advisors, Head of Equity and Portfolio Manager. David, it's great to see you here. Let's start with the one you like, and that would be Progressive. Now this one, haven't done a whole lot this year. It's actually basically flat. It's up like 2%. The street is fairly divided on what to do with this thing. You say it's a buy. Let's go through the reasons why, David. The first reason you say you're committing capital here, attractive valuation.
Yeah, Josh, I don't just like this stock. I absolutely love this stock right now.
That's what we like, the enthusiasm.
Bring it, yes. All right, I got a trivia question for you.
Yeah.
In the last 10 years, all right, Progressive is the second best performing stock in the S&P 100. Who's the first?
Wow, give it to me.
NVIDIA. It's going to be NVIDIA, but no one would guess that.
Yeah.
And yet you've actually had earnings per share growth almost to the same extent from a growth level perspective over those 10 years out of Progressive like you have with NVIDIA. Yeah, to your point, the stock is only up 2% year to date. We're getting some type of digestion right now. I think there's some overblown fears in this market that have priced into this attractive valuation. I mean, there's no point why this stock should not trade at a, let's just say, inequality or in parity with the S&P 500 at 22 times. But right now, it's trading at 13 times forward earnings. That's a 34% discount to the S&P 500. And we haven't seen this much of a valuation disparity relative to the benchmark, the S&P 500, actually since the peak of the dot-com crisis. Yet all the fundamentals still remain very strong. Actually, I think growth is some of the best that we've seen over the last 10 years, what we witnessed over the last, call it, 2 years. And I sincerely believe that Wall Street, their earnings expectations are actually way too low right now. So I think it's a screaming buy.
All right, so the first reason, it looks like a good deal. The second reason, you were hinting at strong growth fundamentals intact.
Yeah, I think we're going to pair this alongside the valuation argument here. Obviously, Progressive, it's a financial, it's an insurance company, but in my mind, it's more of a staple. Okay, staples are obviously sometimes the most expensive house in probably the most expensive neighborhood outside of tech when it comes to valuation. But I see Progressive as more of a staple because you have to have car insurance. Yet you're getting growth rates, EPS growth rate expectations of, let's say, 7, 8, 9% over the next few years, which is 3 times greater the growth rate of most staple companies right now. And not only that, like the model that Progressive has, like they've just been so intuitive really since the early 1990s on their underwriting underwriting process where they kind of have two different levers where they can pull. When a lot of people are going out there looking for market share gains, the company can kind of harvest some profitability and not, demote their underwriting abilities. And when other companies are going out there and not growing and trying to harvest some margins, this company is going to absolutely go out there and try to grow because they have the most intuitive from a technological aspect underwriting process versus all of their peers.
All right, final reason you say buy this one, variable dividend.
Josh, in the United States, we don't have many variable dividend policy names. Obviously, Energy has kind of thrown their hat into the ring here lately, based, doing variable dividends off of free cash flow. It's more of a European style capital allocation policy, but I love it. They have a very, de minimis, call it 16 basis point base rate when it comes to their dividend, very static, don't grow it. And then based off their free cash flow and operating profitability, they're going to yield you, no pun intended, some type of variable dividend at the end of the year. And given the strength in earnings that we've had, they actually report earnings on a monthly basis, which is very weird. Donald Trump would hate that now that he's trying to go to, every 6 months, give or take. But, we could see, almost a $10 variable dividend hitting the market, which the market should absolutely love. And I think that's probably the catalyst here to get this valuation back into historical ranges. The last thing I would say here too, this is a really easy model to kind of fundamentally take out on a time series analysis. I think if you go out and look out far into the future into 2030, I think this company can give you about $50 billion in shareholder yield, whether it's through buybacks, the static dividend, the base dividend, or the variable dividend. And to put that into context, they're planning to give it about $6 billion this year here in 2025. So that alone right there, it's a pretty good CAGR.
All right, so you've made your case, David, convincingly, all right? Before viewers, though, they pile in, what are the risks you need to think about?
The risks are well known, in my opinion. And it's obviously why we've gotten this valuation degradation in the stock over, to your point, actually the last 6, 7, 8 months when the stock's only up 2%. It's all coming back to policy growth. I just mentioned that the stock kind of has two different levers to pull. You can kind of harvest some profitability when everyone else is trying to go out there and extend too far to reach for growth, or they can harvest on their overall margins or grow their share policy count if everyone else is kind of sitting back due to whatever restrictions that they have. So the market is pricing in. A lot of their peers are going to kind of stretch for new share policy growth here in the near term. Let's call it next year or 18 months. And in this market, when it's all about growth, I'm not saying, growth tilt versus value tilt, it's all about earnings per share growth and free cash flow growth, is kind of the main factor contributing to returns right now. If that starts low, or the expectation of it for Progressive, the stock's kind of been hit. I just don't see that coming to fruition. They've been growing their policy count at a very healthy clip, some of the best clips that we've seen in years, which I think should bring that valuation back into parity.
All right, so you like Progressive. Let's turn to one you don't like so much. You would avoid Intel, David, all right? Why would you avoid Intel? Let's go over some reasons there. Insufficient third-party customers.
They've lacked just so much innovation, Josh. And I think when it comes to this name, I actually don't think you can short this name right now. I don't think. I think
it's up about 80% this year now.
Yeah. Who would have thought a year ago that Intel, I mean, like Josh, go back to 2021, 2022, like the biggest pair trade out there was like, all right, let's go long AMD and, support that long with proceeds from shorting Intel. And that's been a heck of a trade for quite so long. So this is definitely flying in the face, this 80% return year to date to many of the market pundits out there. But given the headline risk, and mostly when people talk about headline risk, it tends to be in a negative connotation. Here would be a positive connotation. Obviously, they have their hand in now with NVIDIA and obviously the U.S. government. So I wouldn't want to short this name by any amounts. I think that it could keep some momentum. But if I own shares at this current valuation 25 times forward, I just would be probably trimming my shares.
All right. So let me go. One reason, insufficient third-party customers. A second reason, you'd be avoiding this one here. No innovation, you say, David?
None.
Yeah.
I can't think of the most recent innovation that they've had. I mean, they've kicked the can down the road, kind of like the U.S. government and their debt for quite some time, that they've not been able to grow any of their third-party users. I think for you to get behind this name, you got to get those third-party users on board, new innovations. You have to bring the product to market. You have to get that pushed out into the market in an efficient manner. None of that has happened whatsoever. I mean, you and me both know that kind of the lead time for new innovation of chips, whether we've moved past Murphy's Law, no doubt there. We used to have new chips basically every 3 years. Now we've learned from NVIDIA and Blackwell and obviously their new cadence of chips. Like the cycle's every 1 year right now. And with NVIDIA, if you can't get new technology out or anything along those lines over the span of a few years, and you've been able to do it for the last 3 years, it's tough for me to get behind this name.
All right, final reason you say avoid uncertainty over Intel's fabs.
Even the CEO has uncertainty over Intel's fabs. I'm from Cincinnati, Ohio. Obviously, they had the foundry conversation up in Columbus, Ohio. Obviously, that's on the back burner. But I think the announcement that they had with Jensen, what was it, all of last week with a partnership with NVIDIA, like no one talked about the foundry side of the business. It's almost like you could push the foundry side of the business out from, or at least sell it from Intel just because they are so far behind. I mean, if they get any type of demand there, it's just because TSMC, Taiwan Semiconductor, is fully supplied out. Given the amount of demand there, they kind of get the tertiary amount of demand out there in the market on the foundry side of things. So I think that could get sold off, but you're not getting any type of growth there whatsoever right now.
Finally, quickly here, David, given all that, how could you be wrong on Intel?
If they come out with some type of new technology, I think that would fly in the face of what any analyst would expect. Because obviously they got some capital from the US government, obviously from NVIDIA too, but that $10 billion that's coming in from the US government, like that's not enough to change things whatsoever in my mind. So they're just so far behind the curve. And me and you both know when it comes to technology, like there's some type of economies of scale there. Like once you start to fall back at any point in time, like you're kind of just left in the dust. I mean, there's a lot of companies being left in the dust right now. I think Intel was left in the dust 3-4 years ago.
All right, so there it is. Buy Progressive, avoid Intel. David, thank you for time today. Appreciate it and those picks. And thank you all for watching. Goodbye or goodbye. More Market Domination right on the other side.
Uncle Sam is closed for business, but life goes on. On today's Stocks in Translation, we are breaking down the playbook for planes, parks, pantries, and portfolios, telling you the pain points and down the road where the dominoes might tip first. For planes right now, and let's bring up this chart here. For the planes right now, most airports are open and most flights are a go. But with TSA and federal staff unpaid, those peak hour lines, they can stretch. And national parks are still mostly open, but services are pretty thin. And when it comes to pantries, SNAP food aid should be on time in October, but WIC, which is aid for mothers and children, could tighten soon, depending on the state. And for your portfolio, yes, the Dow, S&P, and NASDAQ, they're at or near record highs, but the industry's watchdog, the SEC, is not reviewing deals, so the IPO pipeline, it's starting to stall. Now let's take a look at some of the heat maps of these effective industries, starting with planes. And I have these here. And this is going to cover the month of October, basically going back to the close of September. So right now we have airports open and pilots and flight attendants are getting paid. And you can see it's a mixed bag for the airline stock returns, but American is leading. And remember that traffic controllers and TSA are on duty but unpaid. This week should mostly hum, but the real risk arises after that first paycheck is missed. That's when fatigue and called-in sick days, they can spike and cause delays. And when those delays hit, we could get a meltdown that causes reputational harm to an airline. Now from runways to trailheads, and here we have the parks. They are mostly open right now, but services are thin. Visitor centers may have limited hours, but tours are paused and bathrooms, they might be closed or not serviced at all. If this lasts, expect more pack it in, pack it out, which means you'll be bringing in your own supplies and carrying out your trash. And we can see these stocks are another mixed bag, with Marriott, Expedia, and Hilton Grand Vacations in the green, while Booking and Airbnb are down. In general, check park status pages the morning of, not the night before. Next up, we are looking at pantries. And the good news is that October payments for SNAP, they should be on time. But WIC, which covers women, infants, and children, has a shorter runway and varies by state. The big retailers from Walmart to Costco will definitely be open. But if the shutdown drags on, infant formula will be the first pressure point. It's made by Abbott Labs, Nestle, and others. If benefit payments are missed, that could ding sales of big consumer staple companies like Coca-Cola, General Mills, Campbell. But the true cost will, of course, be shouldered by those left in need. And last up, let's talk now about investor portfolios. It's no secret that markets have been screaming higher with risk appetite pretty high, but behind the scenes at the SEC, deals are not getting reviewed. That means the IPO machinery is starting to slow, and just as IPOs have been picking up again this year. We've seen some big day one IPO pops from the likes of Klarna, Figure Tech, and Gemini Space, but investors might recall the late 28 shutdown, which delayed the Uber and Lyft IPOs by months. Those big bank tickers mostly in the red here, which is more likely to do with interest rates, but watch out for color commentary on the shutdown when JP Morgan, Goldman Sachs, and Citi report earnings on October 14th. Now, let's talk about what to watch next, and we've got a few items up here. A good rule for preparing for delays is to check websites frequently, as things can change quickly. For travel, look for TSA and airline updates. For parks, watch for status updates and closure notices, as well as travel booking notes. And for food assistance, watch for WIC updates and headlines on formula outages. If this drags into late October, that's when troubles heat up. And for your portfolio, don't read too much into the current price action, which is very risk-on. But do watch out for a slowdown in small caps relative to large caps, as well as for interest rate spikes and notices about IPO delays. The longer the shutdown drags on, the more kinks show up and get magnified. Tune into Stocks in Translation, the podcast. For more jargon-busting deep dives, new episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
President Trump says U.S. home builders are, quote, sitting on 2 million empty lots. It's a record, and he is calling on Fannie Mae and Freddie Mac to force the construction machine into motion. But can the government-sponsored enterprises, still under government control, of course, turn his rhetoric into reality? Susan Wachter, professor of real estate at the Wharton School, joining us now. Susan, it is good to see you. I want to start there on the president's post, Susan, because he did say home builders, they need to start building. They're sitting on 2 million empty lots. The president says that's a record. He asked Fannie Mae and Freddie Mac to get home builders going. Bill Pulte, by the way, the FHFA director, he says he's on it. But on that assertion, Susan, 2 million empty lots, a record, is that accurate, Susan?
Well, the 2 million is correct, but it's not 2 million empty, ready to go. It's 2 million, many of which are not available for construction because they're not approved. So it's one thing to have a lot that's optioned. It's another thing to have a lot where building is approved, and it's regulatory barriers that keep building low because often builders can't get that local approval to build on those lots.
Let me ask you, Susan, when the president says, listen, he wants Fannie and Freddie to get on it, I am curious, what could they actually do, Susan? What are the actual tools they have at their disposal?
Well, that's a very good question. They are not local governments. Local governments control regulations. They're not controlling interest rates. So what can they do? There is potential for some innovation. Some have asked, and I myself have been part of asking, considering acquisition construction loans. Now, Fannie Mae could provide more construction loans, and construction loans, that is acquisition, construction, development lending, is very expensive at this point in time, and one of the barriers, along with regulatory barriers, to home ownership. So there's not much they can do, but they can do something. And they could work with local governments. That's really the key. The key is working together with local governments and perhaps some more incentives to those local governments that are willing to develop in the form perhaps of infrastructure availability.
Yeah, I am interested, Susan, on this theme. Could the federal government force more deregulation on the state, Susan? Could they force more deregulation, cut red tape, boost supply?
No, they cannot force this. This is a local and state matter. They could incentivize, but they can't force this. This is a very strong component of the U.S. defederalized system, in a sense, where state and local governments have control over local building regulations.
Speaking of Fannie and Freddie, Susan, under government control, but hot talk about IPOs, Susan. I'm sure bankers are chomping at the bit. What do you make of that?
Well, I think it's going to happen, actually. I think it's timely that it does happen. It's been 17 years that Fannie and Freddie are in government conservatorship, and they're the profitable. So the taxpayer should not be on the hook forever. These entities should have private capital behind them. And once they do, or perhaps as part of a deal to bring them private, there are potential assistance to lending to builders, for example, maybe even small builders through construction loans. There's a possibility of incentives through the federal government to localities and overcoming some national regulation. Most building local zoning is local, of course, but there are regulations that are federal in terms of some standards that could be eased appropriately. And that's, of course, a big part of the question. What is it appropriate to ease? But putting it all on builders and asking Fannie Freddie, there's no connection there. They can't do it.
And am I right, Susan, to say you would like to see Fannie and Freddie transition into regulated public utilities?
That is correct.
What would be the advantages of that model, Susan?
The big deal is that as regulated utilities, the cost of capital and therefore the cost to the borrower would be less, would be moderated, because they would be safer entities, and investors wouldn't require elevated higher rates of return, which they do for risky entities. And of course, it's extremely important to keep these entities de-risked, as they have been under conservatorship. They were part of the financial crisis in 2008, and we don't want a replay of that.
Susan, great to have you on the show today. Thanks for your time. Appreciate it.
Pleasure.
We are wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination Overtime.